So, today we are going to be talking about one of the more interesting things in the mortgage world, and that is foreign national loans. And in order to discuss foreign national loans, specifically why they're so different from each other, but also why they're a little bit more difficult to get, we're going to have to talk about the rest of the loans that everybody else gets. So, there's three things that we're going to have to understand. First, what does our society do to make it easier for everyday people to get mortgages? Second, who has access to those easier mortgages? And third, who is a foreign national? And once we've discussed those three things, we'll have the basis that we need in this discussion to tackle foreign national loans and everything that you should know about them as a consumer upfront to begin with. So in the United States, we have government agencies that are designed to make it easier for people to buy homes. And the two that we're really going to be discussing today is the FHFA, Federal Housing Finance Agency, and also HUD, which is the Department of Housing and Urban Development. So FHFA is in control of Fannie Mae and Freddie Mac, and HUD is in charge of Ginnie Mae. And what these organizations do, they are government chartered companies that are under conservatorship by these agencies, and their role is to make it easier to facilitate mortgages on both sides of the transaction. On the side of the person getting the mortgage company, and all the way up through when these loans become investments for hedge funds, retirement funds, that sort of thing. It just makes it easier all the way through. And how do they do that? So we'll pick on Fannie Mae and Freddie Mac. They make money by borrowing at lower rates from the United States Treasury, then use that money to purchase mortgages and mortgage-backed securities. They provide liquidity to mortgage companies by purchasing loans from them, then securitizing those mortgages for the investment market by pooling those loans together, and then turning them into mortgage-backed securities that they either hold on to and then use that money to reinvest later, or sell those to the markets, sell them to hedge funds, retirement funds, that sort of thing. So that's kind of complicated, but what is the takeaway for our discussion? So our system makes it relatively easy and standardized for people to get mortgages and for institutions to invest in those mortgages. So a lot of the guidelines and requirements are really protections for the people who are the homeowners, but also for the institutions who are investing in these mortgages. For example, mortgage insurance, people who are putting less than 20% down on a conventional loan. The guidelines require that those loans have mortgage insurance. So when somebody doesn't pay that mortgage, the investor is still protected. And when you're an institution buying these mortgage-backed securities and you know that it's a pool of conventional loans, you really are making a relatively safe investment because you have those stricter guidelines coming from the top, meaning that the quality of the loans is high. You have really the guarantee, not explicitly, but that this is a government institution, that it's relatively safe compared to other investments, compared to stocks, for example. Our system makes it relatively easy and standardized for people to get mortgages and for institutions to invest in those mortgages. Those mortgages that are created within this cheaper, more efficient system, they all follow the same rules that come from the top of these organizations. So if there's a rule from HUD, it goes down to the government loans. If there's a rule from FHFA, it goes down to the conventional loans. And within those organizations, Fannie Mae sets all the guidelines for their conventional loans. Freddie Mac sets all the guidelines for their conventional loans. So you have this homogeny of standards, and that is an aspect of the system that we are going to address, because foreign national loans exist outside of that system because the guidelines really don't allow them to exist in the same way that most people would be getting a mortgage and living their life to qualify for a mortgage. The side effects of this system, a conventional loan is always a conventional loan, and it always follows conventional guidelines. So if you have one mortgage company and they originate a mortgage, a conventional loan for one borrower, in theory, that borrower could have gone to any other mortgage company that does conventional loans and applied for and gotten approved for the same type of loan, the same conventional loan. And the same principle applies for FHA, VA, and USDA loans as well. And like I mentioned, none of these loans really allow foreign nationals to get a mortgage within the guidelines that they have for their different loan programs. Fannie Mae, out of all of them, is probably the most lax about non-citizens getting a mortgage. And this is what their guidelines say specifically about citizenship, residency in terms of a mortgage. Per the selling guide, Fannie Mae considers a borrower legally present in the United States if they have a social security number or individual taxpayer identification number, and they have current verified status, which may be documented by a valid employment authorization document or other documentation showing immigration status is current, example, green card, work visa, etc. This ties directly into our second point: who has access to these easier mortgages? This is a gray area, but we've already begun to answer this question in our discussion. So really the first thing to say is people who are legally present in the United States with a social security number or an ITIN. So really people who fall into that category is somebody who's a citizen, which is a lot of people, permanent resident green card holders, so that's people who are in the immigration process, somebody on a work visa who may be here temporarily but is living and working legally here, somebody in the DACA program who has an employment authorization document. All of these are definitely not in the gray area, and I can say that from reading the guidelines, but also in my experience because I've done loans for people in all of these situations. So since this list is open-ended, how foreign can we get and still do a conventional mortgage? And I say conventional because really out of the four categories of conforming loans, the only one that makes sense in this context is conventional. VA is only primary residence, and you have to be in the military. So you're not going to be in the military if you're a foreign national. USDA and FHA only allow primary residence, and you really can't do a primary residence loan when you're not able to live in your primary home for most of the year. So even the most generous visas, I don't think you can stay constantly, which really what you would have to do to be able to say that it's going to be your primary residence. So what about second homes and investment properties? It seems on the surface that there is kind of a gray area, looking at those Fannie Mae guidelines we looked at, that we could put an argument together for doing a mortgage for somebody who has access to the U.S. because of their travel visa, because they come from a country with a visa waiver program with the United States, that perhaps we could argue that they have enough access to our country where they could do a loan on a second home or an investment property, and they have enough access to that home to justify doing a loan for it within those conventional guidelines. In practice, this really doesn't work well. In order to use foreign income on a conventional mortgage, we need to show 2 years of U.S. tax returns claiming the foreign income on the tax return. Really, that guideline is in place. It's designed for people who are living in the United States, but maybe working abroad, and they're citizens or they're permanent residents, and they want to buy a home back in their home country in the United States, and they have that foreign income. That really is what that guideline is designed for, because you have 2 years of tax returns required for it. You are not going to file foreign income as a foreigner on a United States tax return if you don't live here. Why would you pay taxes if you don't live here? Just using rental income from an investment property on its own is almost never enough for a conventional loan to qualify for a mortgage, especially a purchase mortgage. So the addition of foreign income would likely make somebody qualify, but it doesn't make any sense for a foreign national to claim that income on their tax returns for 2 years as it's required in order to do a conforming conventional loan. So really, the income part is a problem right off the bat, and that's going to disqualify the majority of people. On top of that, there's a good chance that this person does not have a U.S. credit score or credit report, which isn't the end of the world, but it just adds another layer of complexity and difficulty for the mortgage process. And the thought that I have first is, how are you going to price that loan? You're going to get terrible pricing. If you don't have a credit score, you're really not going to be able to get a competitive, good deal on a conforming conventional loan. So I haven't really had an opportunity to ask an underwriter about these guidelines because out of all the foreign nationals that I have come across, none of them have even remotely fit the narrow box of what you can do with a conventional mortgage for a foreign national. The structure of the requirements narrow down the list of people who are considered foreign nationals who can also get conventional loans to basically just people who are on a work visa who have established credit history with the United States, within the United States institutions. So it's kind of like, it just doesn't work. I keep using the term foreign national, but I haven't really explained it yet. So that's our third point. What is a foreign national? So here's what the government has to say. An individual who is not a citizen of the United States and not lawfully admitted for permanent residence. So technically, only citizens and green card holders are not considered foreign nationals. For our discussion purposes, though, for foreign national loans, I would add on top of that somebody who has a combination of only being in the United States for tourism or temporary stays for business, receiving foreign income as the majority of their income, having little or no debt history in the United States, not having an ITIN number. All of these, and really the more of them that you add together to somebody's situation, the more likely we're going to do a foreign national loan for them. Because these are all obstacles that would prevent you from getting a regular conventional loan as a citizen or permanent resident or somebody in the immigration process could do. So if we can't do regular conventional FHA, VA, USCA loans for these people, how do they get loans? Can they get loans? Really, the answer is yes. We probably wouldn't have made it this far making this video if the answer was no. But yes, there are loans that foreign nationals can get to purchase a home, to do a cash-out refinance, rate and term refinance, all of that stuff. So going back to our conforming loans that we were talking about in the beginning of this video, that have all the same rules, all the same programs, only a few programs, this is the complete opposite of that. So instead of having that centralized mortgage standard, it's different for every single institution, for every investor, every lender has their own requirements. You'll see a lot of the same themes in these types of qualification, but all of the different things that you can play with, terms, costs, qualification requirements, all of it, you're going to see lots of variation. Foreign national loans are considered what's called non-QM or non-qualified mortgage loans, and that's a whole nother topic, but what that basically means, like we've said, is there is no government agency who is going to be backing these loans, securitizing them. It's all done through either publicly traded or private institutions who are not the government. We're going to use two different examples. I'm saying examples loosely because this is kind of two archetypes of investors that I kind of threw together and borrow guidelines from one investor to the other. I'm not going to read off rate sheet or guidelines on any specific investor here for a variety of reasons, but this is to give you an example of what an investor might look like if you were to try to qualify for one of these types of loans. So we'll take investor A first. Minimum loan amount of $250,000, minimum down payment of 25%. Side note on the down payment. So with these types of loans, non-QM and specifically foreign national, they are more risky. So you'll a lot of times see higher down payment requirements and higher interest rates. So the higher down payment sort of mitigates the risk of default. You have more money invested, you're less likely to walk away from that investment. You're more likely to keep making your mortgage payment. And higher interest rate to compensate investors for the higher risk of lending to somebody who doesn't live here, doesn't have full access to our country. Back to the investor we're talking about, imaginary investor A. Broker fee 2.75 points. They only offer adjustable rate mortgages based off of the 1-year CMT, constant maturity treasury, plus margin. And they have a few options to choose from. So they have a 3-1, a 5-1, 7-1, and a 10-1. So that's 3 years fixed, adjust once a year, that sort of thing, and applied to all those others as well. No rental income from the subject property allowed. So maybe this investor, they don't really trust people who say it's going to be an investment property and then use it as a vacation home so that they can qualify easier. They want to vet you and make sure that you're going to be able to make that mortgage payment regardless of anybody's living in there, whether it's you, somebody else paying rent, whoever that is, you have the money to pay for that mortgage. No bank reference letters are needed. However, this investor wants bank statements, international credit report, or a native credit report from the home country, or 3 credit reference letters, proof of residency and housing expense for their primary home, accountant letter for somebody who's self-employed stating how much money you make, or pay stubs for employees. Everything must be professionally translated into English, and currencies must be translated to US dollars if everything is not in those as already. If the client's not from a country that is a native English-speaking country, then interpreter is required to attend closing based off of their language. They also have about 24 countries on a blacklist and higher reserve requirements for borrowers from gray-listed countries, which may be countries with currency controls or are likely to put currency controls in place. So that's kind of like one example of what we might expect. Now let's look at another. Investor B has a minimum loan amount of $75,000, so they'll let you go lower. The only documentation required from the client is asset statements, proof of foreign residency, and identification. Instead of looking at how much money they make, they look at how much money the property is going to make. So really taking the opposite approach of the last investor. Qualification is based solely on cash flow of the property, and the loan is only available on investment properties. You have to state that it's an investment property in order to get the loan for it. The interest rate is fixed, but much higher than investor A's starting rates and rates in general. 6 months reserves are required regardless, and everything, all those reserves must be held in a United States bank. Everything must be professionally translated to English if it is not in English already, and if the client is from a country that does not speak English natively, then an interpreter is required to attend closing. Different but similar blacklists and no gray lists. Prepayment penalty can vary between 0 and 5 years, and taking a longer prepayment penalty will give a lower interest rate. So based on these two examples, you can see just how much variation you can see between different investors. So really depending on the situation, depending on somebody's specific finances, what they're looking for out of the transaction, what they're going to use that home for, what their income sources are, all of this together really paints the picture of there's a lot of variation, a lot of differences, lots of different requirements, and you can end up with wildly different loans just by talking to 2 different mortgage professionals based off of who they have access to with their investors. So this has been a lot of information. What's the takeaway? Really the takeaway is because of all of this variation in the non-QM space and the foreign national non-QM space specifically, you really need to look at all of your options, as many options as you can when considering a foreign national loan. and really be kind of flexible, open to different things, because maybe the best option for your finances, you may have to adjust your plans a little bit to make that work. So expect to have a high down payment, expect to have a higher interest rate than you hear on the news for people who are getting mortgages for conventional loans. But keep in mind that there's lots of options out there, and you may be surprised on what type of loans you can find and what you're going to need in order to get that loan. So I do foreign national loans. I have a few different investors who offer those that I am familiar with. If you would like to look into a foreign national loan, I am more than happy to help with that. And I look forward to answering any comments you guys have, any questions you have in the comments. And thank you for watching.